Hello, I'm Peter Switzer. Thanks for joining me on Switzer. The AFR looked at a lunch between one of its journalists and Hamish Douglass, the co-founder of Magellan Asset Management, which has been a truly great investment performer. He's invested in companies like Macca's, Yum Brands, which owns the likes of KFC, and he's also invested in Starbucks. Now, all of these might be the kind of companies that have products that most parents actually fear, but they are also the products, and their stores are the places where people go en masse. Douglas learnt from Warren Buffett, who invests in what people use daily, as it is a great basis for finding what kind of stocks you want to invest in. Investing in companies that sell stuff that we want to buy is not a bad investment strategy. And keep this in mind when you're selecting your stocks. On the show tonight, Julia Lee from Bell Direct and the Switzer Report's Paul Rickard, who also was the founding CEO of Comset, look at the market today and some of the smart stock selections going on in those heads of theirs. Charlie Aiken will tell us what stocks he owns that are his favourites and he thinks have plenty of upside. And then Steve Keen does not believe that the house price bottoming headlines, he doesn't believe that they're true, and he's sticking with his 40% house price falls despite what those headlines are saying, but he concedes, now wait for it, he could be wrong. Thanks for joining us.
Pleasure.
So let's start with you first, Julie, because you look at the market in a very clinical and analytical kind of way. What happened to the market today?
Well, we did see that negative lead come through from Wall Street. And look, the market's going to be focused on two things from the US. One is earnings season, which is in full force at the moment. And the second is the Federal Reserve interest rate meeting on the 31st, so right at the end of the month. And the market's a bit divided on whether we're going to see 25 basis points or 50 basis points. But given that negative lead out of the US, the Aussie market did come under a little bit of pressure, down by 0.2%. Interestingly, it was those dividend areas which came under pressure. So looking at the property sector, utilities, telecom, they were all sold off. And I think part of it is the dividend effect. Property stocks, they paid their dividends in June. The next dividend isn't until December. So really a lack of catalyst until...
But there are professional dividend harvesters who buy their stocks and then eventually get rid of them to go and chase other ones, don't they?
Absolutely, and I guess when you look at dividend harvesting, when you see a strong run-up as property has, there's probably little value in holding onto them after the dividend's been paid, because the whole dividend and the franking effects probably been captured in the share price.
Now, Paul, you and I think that this dividend push up of the market will eventually end and there'll be a rotation probably into growth stocks.
Yeah, I think that's what you're probably seeing a little bit, Peter. I think when you sit back, you see some of the defensive stocks. You see Transurban above $15. You see Sydney Airport above $8. You see Medibank at $3.60. Unloved 2 months ago at $2.70. You're right, before the election. There's a few other reasons, but you couldn't get anyone to buy it. I think people are just a bit wary about defensive stocks and saying, look, and as I know Charlie said before, this is almost the first time a rally's been led by the defensives, right? You have to go back a long time to see that, if at all.
So defense.
Yeah, and a lot of the cyclicals are so cheap. And I think we might almost be starting to see a little bit of rotation, or if not, some of the institutions just maybe doing a little bit of profit taking on the defensive.
And why would you be profit taking? Because we're still waiting for a trade truce. Do you think the trade truce is a lot longer out than we thought on March 27th?
Probably, although the noise around the traps is that the US has started to buy some of those soft commodities from China that it hasn't been for a while. So there's a little bit of thawing out, but look, I think this is going to be a long game. But talking about styles of investing, so looking at growth versus value versus defensive, these things are cyclical as well. They tend to favour different parts of the economic cycle. So after we saw the sell-off last year from about September to December, really we saw growth coming back into favour, and the defensives have been running hard as well. But we've also seen a bit of a move into the quality end of the market, where the large caps have overperformed or outperformed the last 6 months compared to small caps. And what I think we're starting to see is a little bit of profit taking in some of those areas that have done extremely well, but also a bit of a rotation into value. Some of those value
But
stocks.
isn't it also fair to say that a lot of those quality companies were smashed by the Royal Commission and the threat of Bill Shorten? And so when that was taken away, that's another reason why there's been a lift up. Paul, what do you reckon?
Yeah, I think that's right, Peter. I mean, look, and again, the other thing that's happening, of course, is we've got so much money going into passive investments. And you've got to realise they have a big impact on the market. And so when everyone puts money into, SDW or IOZ or the BAS, that means a certain amount goes into Telstra, means a certain amount goes into Westfarm, a certain amount goes into Woodside. And if you're an index manager, you start with the big companies first. That's where you've got to be close to market weight, or very, very, very close. So it is almost a little bit self-fulfilling, but I think there has been a shift. We've seen in all the data says the top 20 stocks have done better than the small caps. I get a sense there's maybe just a little bit of rotation starting to come back. And I read a brilliant article that you wrote today, Peter, which is normally your line, which talked about ISO and the fact it's still well below its peak.
Yeah.
That's the ETF that tracks the small ordinary index. It's still well below its peak from last year, which is quite surprising.
Yeah, and I think if there's going to be a rotation, those small caps will probably pick it up. Julia, let's talk about stocks that you really like right now. 'Cause you've been on a tear. La Vista was a great one. You had a great week last week, and you've been on to that. We won't mention any ones you made a mistake on. You also your horse one again. You didn't tell us what kind of tipster is she. But okay, what else?
Well, around about a year ago, I was just looking back on some of the articles I wrote for you, Pete, and I noticed that IDP Education was a pick in September last year, and that's done extremely well.
That was a bit of a left field selection, wasn't it, I thought?
Yeah, but look, India was a hugely growing market, and those, I guess, demographic factors are still in play at the moment. So I think that's still a positive. And look, the other one was Pro Medicus, which I recommended at the ASX Small Mid Cap Index last year. But look, that's probably looking a little bit overvalued. If I can give you a bit of insight into what I've been buying the last couple of weeks. One of the stocks I've picked up is New Farm. Look, I've tried a few. I've tried with New Farm, and I've been stopped out when my risk management comes into play. And I do recognise that it's very difficult to pick the lows of cyclical stocks because droughts and cycles can go on longer than expected. So I've used technicals as well to try and see when a base is forming, and things are looking pretty good at the moment. I'm thinking of increasing my stake into this stock. I've already bought in. I'm thinking of increasing as well.
I nominated to look for some income stocks outside the top 50.
Yeah, good idea.
Some of the top defensives have got so expensive. These aren't all defensive. I think there's a little bit of cyclical risk in a couple of these, but the ones that I've looked at, and I think there's a bit of value in it, are the Viva Energy REIT. That's VVR, I think. I think Viva itself, which came to market last year at $2.50, bombed as an IPO, didn't really like it much, went down to $1.80, is now back about $2.25. I think there's a bit of value, and there's a bit of a risk around refining, but the retail and wholesale business is okay. Babcock, which will report, I think it looks okay.
Rudy Philippek always loves that.
Yeah, I think they've been beaten up partly, not beaten up, but they've sort of been hit by the electric vehicle sort of idea. As sort of will long-term kill the sort of the auto parts, servicing, wholesale trade. They argue back pretty comprehensively that the fleet in Australia is still growing. Electrical vehicles are less than 0.5%. To get to the target that the ALP talked about, I think 50% of the fleet by 2030, which is new car sales, that would still only be 7% of the fleet. So some of the, if you actually look at the mass, the car market doesn't look as bad.
Electric cars still have engines, don't they?
No, but they don't. They still have some mechanical parts, but not as many, Peter, and they don't break down as often. So
you just get uploaded your upgrade or your fix. Still need brake pads.
So I think Babcock's worth looking at, and the other one's probably a little higher risk is, and maybe not in that category, but another beaten up cyclicals, Adelaide Brighton. And
that's brave.
That's a brave call. So I'm looking for yield, whether it come off a bit. I don't know. It's my least confident.
Well, I'll give you one positive for that. An architect friend of mine asked him how her business has been for the last 2 years. He used the word worse than crap. I said, what's it like now? He said, I got 18 inquiries last week. He said banks are starting to lend.
They are starting
And if
to
they're starting to lend, they're starting to build, and maybe Adelaide Brighton could be a 6-month play.
Yeah, I mean, look, I think it's maybe more like FY20. I mean, residential buildings still a key part of their business in terms of supplying construction materials to that. Yeah. We've seen some good figures come out of the. The downgrade was just before the election, and a lot of things have changed post the election. But also, Peter, just on that theme, I mean, we've seen a lot of these signals come off. If we're now going to see the impact of interest rates, more government spending, there's going to be a little bit of a pickup there, and some have moved. I think you've certainly seen it in the retail sector. I mean, look at the JB Hi-Fi's, Harvey Norman's, and others post the election, huge bounces. Haven't seen it in some of the construction sector much. Markets out there, but one to look at, and a brave call, but
one final one, Julia. You'll get it so easily.
Well, I still like Eclipse. I still think that that's going to continue to improve as the risk of the capital raising disappears, and we get confirmation of that in September when the lenders look at those covenants. But offloading the non-core businesses means that it's going to be valued on its core business, and that's just going to be positive.
And what have you sold? What for an interesting take? What has Julia Lee sold recently?
I haven't sold anything actually.
Well, that's a tip in itself. If Julia Lee's not selling.
See, my sales would be a little bit out of market, Peter. I would have been out of Woolworths. I'd be out of Transurban almost, getting up these levels. But that's been against the market. The defensive shift has been so strong. And
an interesting thing, Paul, is that it depends on what price you bought with farmers and colours.
That colours it a little bit because you remember when interest rates are on the way up and everyone is saying they're an interest rate proxy stock and they're going to get smashed. You said, well, they've got most of their money hedged. In fact, it's not quite the case. But
Paul, how about if interest rates continue to go down, not only here but over in the US? Would that still mean it's stocks like Transurban and
look, I think it's more profit taking than I wouldn't go short the stock. But I mean, I think there becomes a point in any cycle where for retail investors, you don't have to get. I don't think there's anything wrong with a good old term deposit paying 1.5% or 2%. Sometimes that's not a bad strategy. Preservation of capital can still be a key strategy. I mean, if you look at
he's getting old before my very eyes.
But you look what the institutional market is doing, being forced to do overseas, Peter, is invest in bonds at negative interest rates and put the money back into gold. So it's not as though, and then have it. It's not as though that there's a. You have to be an investor and be happy with low interest rates.
Let's finish on gold.
Yeah.
Would you buy gold, Julia?
I think gold's looking good, especially as we look at lower interest rates around the globe. It means that there's a lower opportunity cost in carrying gold. And markets, I think, are getting nervous about the amount of firepower left with central banks and governments, given the ultra low interest rates we're seeing around the globe.
Paul?
No, I think there's a case for gold, given this interest rates are now so low and as though the central banks are talking about more stimulation and pump priming. I mean, there's probably is a case. I've never been a huge gold bull.
Neither.
But maybe there's a case for a small part in the portfolio as a defensive
a gold ETF called gold.
I think if you want to play gold, that is the easiest way to do it. The thrill seekers can go from some of the Australian gold companies, but the easiest way is the ETF GOLD.
Okay. Best gold company to buy?
Well, it depends on why you're buying gold, because during the global financial crisis, global gold mining companies and ETFs were still sold off. So whether you have the physical, whether you have the company, or whether you buy an ETF, depends on why you're using gold. And I guess if you're looking for an external shock, I'd choose something like physical gold. But if I'm looking at trading a point of view, then I don't mind the list of products on the market.
Okay, that's Julia Lee and Paul Rickard. Guys, thanks for joining us.
Thanks.
Hi, I'm Peter Switzer.
And I'm Paul Rickard. And we'd like to invite you to our 2019 Switzer Listed Investment Conference.
Now, the Switzer Listed Investment Conference brings together some of Australia's best money managers. On the day, they'll tell you how they're investing both at home and abroad and give you tips on how you can maximise your investment portfolio. Tickets are only $49 and available to purchase now. Don't miss out on your opportunity to hear from Australia's best money managers by securing your spot now. For more info and to purchase tickets to the event, head to www.switzerevents.com.au. Attending will help you make well-informed financial decisions this year and maximise your portfolio. Steve, thanks for joining us.
Good to be here, mate.
Now, last time we spoke, I gave you a really good chance to actually articulate the reasons why you're worried or why you're predicting Australian house prices could fall by around 40%, right? Now, of course, a lot of people said, fantastic, gave him a chance. Other people said, Keen's wrong.
Exactly.
So today I'm going to play devil's advocate and I'll run through the sort of arguments they would pit against you and you then can return fire. So for those people who don't know your story, why don't you restate why you believe that Australia still could have a 40% fall in house prices?
Well, the basic story is that what I focus on, and this makes me different from all mainstream economists, like 100% of them, and even a fair number of non-orthodox economists, I focus on the role of private debt in a capitalist economy. And they leave it out. So if you look at, for example, the chief economist, one of the chief economists of the Reserve Bank is Dr. Peter Tulip.
Yes.
Okay. He has written a model of the Australian house prices with 25 variables in it, I think, none of which include the level of debt or credit. Okay. And what I focus on, we'll look at the chart that I'm showing on the screen. That's vital. If you leave that out of your thinking, you're not going to see what's happening.
Now, obviously, over the years, in your academic years, you're fighting with people in the public eye, which you've done for a long time. You must have said this. Why that mainstream economists do not include debt in their analysis of what could go right or go wrong. What do they say to you when you say that?
They say that debt is banks are simply financial intermediaries who arrange a transfer of money from savers to borrowers, and that's all they do. They don't actually create money. And I've been saying for 50 years that's total nonsense. You look at what banks actually do, they create money. And
that's the velocity of circulation.
No, it's not the velocity, it's the actual creation of new money. And the mainstream economists say they're financial intermediaries. It's literally the term anybody doing an economics degree has seen the word intermediation, blah, blah, blah. It's simply between a saver and a borrower. That's all they do. And I had to quote non-orthodox economists all the way through, people like Hyman Minsky, obviously, Basil Moore, Schumpeter sometimes, Irving Fisher, but I could never quote anybody in authority. As of 2014, I have been quoting the Bank of England and the Bundesbank, and they say banks create money. They are not intermediaries, they create money. And then what I've done, which no other economist has done as thoroughly, is to say, well, what does that mean in terms of macroeconomics? And what the answer is, change in debt, which is credit. The annual change in debt I call credit, is a contributor to aggregate demand. And if you have an economy relying upon credit, you necessarily have rising private debt, and at some point you reach a maximum, down it goes, credit goes negative, you have a slump.
Okay, so now tell us why you believe, given that's what you believe, tell us why you believe debt is going to cause such calamity. And it would be a calamity, a 40% fall in house prices. And you don't just say Sydney and Melbourne, you go national.
I don't work at the detailed data. If you want the detailed stuff, you talk to Philip Seuss and people like that, or Martin North. My stuff is really aggregate level, aggregate dynamics.
So at least, even if you didn't get 40% across all of Australia, you'd think the big markets like Sydney and Melbourne would be susceptible.
I mean, it's when I first said that 40%. Let's get this historically right. That was an answer to a question I think from Kerry O'Brien, without notice, in the 7:30 report. And what I said was, well, Japan had house prices fell about 40% in the 10 to 15 years after their bubble economy burst in 1990, and I see no reason why we'll avoid that fate. It wasn't a prediction in that sense. It's saying this is the consequence of having a private debt bubble.
But as you know,
everybody that's all they talk. Everything else argued,
as you know,
that went out the window. Just that.
That's right.
This is Australia.
That's right.
Who cares about what you think?
But it may well be a 30% fall.
Something.
But you're going to say it's going to be a lot bigger than what we've seen so far. Because
we've seen 10% so far, roughly.
Across the country, and Sydney's 14, Melbourne 11, and people are now talking about we look like we're bottoming. And you'd be inwardly laughing.
I'd say we're having. I saw one of my Twitter correspondents called it a Schrodinger's cat bounce. If you know your physics, that means a dead.
Most of us
cat
don't.
bounce. There you go.
A dead cat bounce. So therefore, let's go to the chart that you think explains why you're right, and then I'll start hitting you with other people's views so you can respond to them.
Well, I'll put the context in first of all, because this is, when I started doing this stuff, I only had data on two countries, America and Australia. That's all I could get data on for private debt.
And neither of them have had massive, even though the GFC wasn't great for America, nationally they're getting 40%. Some Florida got crushed.
Mate, sorry, 39.6 roughly.
Yeah, no, but not across the country.
Yes, yes, that was the country average.
Okay.
I say the country average house price fall in America was almost precisely.
But
40%.
certainly California, Florida copped it. I guess New York did as well.
Yeah.
But I haven't seen that number. But look, I will trust your numbers.
Okay,
all right. Okay.
40%.
All right, so
the first chart we're showing is the actual level of household debt to GDP going right back to 1950, and this is what people aren't conscious of because we didn't have the data going back that far.
Okay.
Okay. So you see, Australia starts at under 10% of GDP. That's the level of household debt way back in the 1950s.
Yeah. Very different country, as you know.
Yeah, well, food was rat shit.
That's right.
Okay, boring stuff. None of this great Asian food.
Yeah, but I don't think we're aspirational yuppies in those days as well. Because I remember in 1987 when I did my first TV show with Clive Robertson, I had to go and buy myself a Country Road jacket just to. No one even owned suits in those days. All right, go on.
Anyway, so you see that we're right down the bottom of the level of private debt compared to America, compared to Canada, and so on.
We were very responsible looking in the 50s.
We were in the 50s. It really took off actually. I've actually blamed my favourite politician for this, Paul Keating. It took off in the 80s. But
deregulation was a big issue.
Deregulation was a big cause of it. We were the first to do that. And you can see from about the 1980s on, the level of private debt took off on the country. So well below America, well below Canada. And then bang, you go fast forward to today, and we have the second highest level of private debt on the planet. Only below Switzerland, which has a lot of interesting.
Almost, my name is Switzer.
I know Switzer. I feel
a little bad about that.
Bad choice of countries, mate.
That's right.
But Switzerland does have a lot of that. The old gnomes. You're not a gnome, obviously, but the old gnomes of Switzerland.
Yeah.
A lot of that money, I've been told by friends who check the data more carefully than I've had a chance to do. A lot of it's interesting.
Yeah, Germanic.
So actually, in that sense,
others went via Germany in the old days. Yeah, but go on.
Luxembourg's even crazier, by the way. Luxembourg's a population of about 300,000.
Okay, get to the point.
So therefore, we have the highest level of private debt on the planet, outside a country famous for money laundering.
Yeah.
Leave it out with the highest level of debt. This other country you can see there is Denmark. That's the top one, which hit a peak of 140%. It's come down.
That was in the GFC?
During the GFC. Yeah. America hit a peak. America's looking for America's data there on the chart. It hit a peak of 170. I'm thinking of total private debt there. It hit about almost 100%. It's down to about 78. All of them have fallen. And when they fall, when the level of private debt falls, credit's negative.
Okay. So is the brown line America, or is that Ireland? That's Ireland, isn't it?
Kind of challenging our eyes there. Ireland is the weird one. It goes
up a really big drop there.
Absolutely. Ireland went from 50% of GDP in 2003 to almost 120% in 2010, and it's back down to about 45%.
Yeah.
Absolutely crazy.
And Denmark's fall is obviously less than.
Yeah, but it's been headed. Denmark now has negative interest rates and zero interest rates. But loans are virtually zero, but the debt level's still falling. So that you hit a peak, you come down. That's. I don't even need to give a theoretical explanation. I can say empirically that's happened to every country on the planet. And Australia's just joined them, starting at about 2017.
Okay. Now, one thing someone would say straight away is that in all those instances, the GFC, that was a situation where the banks of the world didn't trust each other, correct? After the debt rating agencies...
Well, no, the banks of the world admitted they didn't trust each other.
Yeah, that's right. But for example, with the 87 crash, that wasn't the same kind of problem.
No, the 87 crash was actually corporate debt.
Yeah, exactly.
Fundamentally, lending to, as Christopher's case, is the Allen bonds of the world. Yeah.
Okay.
Yeah.
So what if the next recession... I'm presuming that the trigger in Australia is going to be something global.
No.
No, so it's going to be... You think it's going to be homegrown.
So
the rest of the world might not be in a recession, and we will go into a house price collapse.
And so the same for Canada and a few others.
Okay, so you better explain that one.
Okay, well, actually, let's page through a few of the graphs here. Did we find the right one?
You got more graphs.
Now sorry, you're stuck with it. This is America. Now you look at America data. That's the one. The red line is household debt, which you've seen in the previous chart. The blue line is the house price index. And just to make my point about the 40% fall, if you look at the blue line, it peaks in about 2006 at about 230, and it falls to 140. Okay, that's a national fall. Now you look at it, and there's rising debt. For first of it, rising house prices. Then you have falling house prices, falling debt. Then you've got this weird thing of falling debt and rising house prices. So if you look at it, it's really hard to interpret that. Page on to the next one.
But before we go, the bottom line is that happened in the context of what America called the Great Recession. So you're saying
we're going to have a
So we need to have a serious recession for your house
but
price.
this causes the serious recession. This is the cause.
Okay. That's
Okay. Next one.
Yeah.
Now that's looking at Australia, and what you can see, the household debt for us has just continued going up. You have ups and downs in house prices over time. Believe it or not, there are other times in the past.
It seems to be leveling off, Steve, to be fair.
You're looking
very
at the,
high levels.
You're looking at the blue line or the red line. Which
no,
one?
the red line's leveled off at.
It's flatlining, yeah, but okay, that's showing you the level of household debt and the level of house prices. Now, my argument is there's a causal relationship between the change, not in household debt, but the change in household credit, which is new mortgages, okay, fundamentally, and the change in house prices. So page on to the next one. That's the American data again, and what I've done, I've looked at the change in household debt. I've got it badly labelled there. That's change in household credit.
Yeah.
So you look at household debts like 100%.
What you prove there's a link. That's a
strong link.
For normal people watching and saying, what in the hell are these two guys doing?
The big link.
Okay. So are we heading to a chart?
According to economic theory, there's no link.
Okay.
According to mainstream theory, no link at all.
It just happens to be an unbelievable correlation.
And that's what Peter Tulip ignores because he said it's zero.
Yeah.
I assume it's zero if I don't look at it.
Okay. Next
one, Australia. Okay, that's looking at the private debt between the countries.
Okay.
And we've gone far in excess of America.
Yeah.
So
we didn't have a recession, did we?
Because we borrowed our way out
That's
of
right.
it.
Okay.
Next one.
And that's going to be an important issue going forward.
And that is looking at private credit. So
Okay.
this is saying the blue line again is Australia's private credit level, annual change in debt.
Yep.
The red line is America's. We had a bigger bubble in Australia. We didn't have the negative period. You see, American credit went from 15% of GDP at the beginning of the GFC to -5.
Yeah.
We went from almost 25%. We didn't hit negative.
Okay.
We hit 2.5.
Now, can I be objective? Can I get you to be objective here? A part of the reason why we didn't have the same challenges America had was that our big four banks ended up in the best 10 banks of the world at that point in time. Whatever the analysis is, that is what the world said at that point in time.
Mate, I've got to say, they are the world champions at bank fraud.
Okay, well, okay.
And I'm willing to stick by that. What puzzled me?
You do admit that the world was saying there were 10 reliable banks at that point in time, and our big four were there. And whether it was falsification or not, you know that the world is based on perception.
Yeah.
And the perception was... and also behind
temporarily perception.
And behind it also was a government that was saying, no matter what happens, we're going to protect these guys.
Okay.
And I don't think... Remember, Ireland didn't want to do it. Iceland didn't want to do it until they had to do it, correct? Am I right there, Anna?
Yeah.
Okay. So
but let's actually... Has that ever happened in history before?
What?
Has a country had its banks ranked in the top 10, most of the top banks, top 10, and something went wrong?
Yeah. Oh, yes, I'm sure it has.
Well, you should know. Japan.
Yeah,
in 1990, Japan had 9 of the 10 world's top ranked banks. 9 of the 10.
This is your speciality. I've never studied the history of the best banks of the world.
Japan, literally, if your country has the best banks in the world, watch out. Okay. Japan had 9 out of 10. Now I'm going to mention my friend.
You are becoming a media man. That is a generalisation that no economist would do.
Generalisation. It's a
based on historical fact. Okay.
The third one. Another country that got a fantastic rating, first-class banking system, about 3 weeks before it collapsed.
Probably the USA.
No. And it got 2 questions. Which country? No. Which country? And who gave them the rating?
Okay, come on, give me the answer.
This is the mastermind stuff. Iceland and somebody who works for the Reserve Bank of Australia.
Okay, right, we'll leave it at that. All right, now let's get. Is there anything else you want to impose upon us?
Okay, this is looking at private debt, private credit, and unemployment in America.
Right.
Now, you're old enough to know what the Rorschach plot is, aren't you?
Oh, yeah, but come on. So ask me questions. Since I've taught, mate, but go on.
One goes up, the other goes down.
Right.
And that is supposed to be zero, according to no particular relationship. That's mainstream economic theory. That's the data. Next one is Australia. Now, we're off the chart. I've used the same scale for both. Not a strong correlation, minus 0.67 rather than minus 0.85. But that's why I say when credit slows down, unemployment goes up.
Yeah, well, and let's face it, why is the Reserve Bank cutting interest rates?
Yeah, they want credit to start going again.
They want debt to get out there, they want the economy to grow, and they want unemployment to come down. But it's just so obvious stuff.
Yeah, but the thing is, when they do it, it would be great if they didn't mean rising debt. But it does.
Okay. Now, can we go to some issues now?
Yeah.
All right. you've made your point, as you always do. And then people still say, he's an idiot in your absence, I know.
Look, tell me about it, yeah.
All right. So I've asked you a question, will it be an Australian thing or a global thing? You say it's an Australian thing.
Yeah, there'll be global element. America's not going to have a DFC again, nor England, but yeah.
So next question, why won't a macro response again kick the can down the road and people will then say, Keane is wrong again?
Yeah. There will be a macro response.
It
will kick the can down the road. The question is, how hard is the can to kick? Back in 2007, Rudd's doubling and trebling the first home owners grant. The Victorian as well. You were what Victoria did at that time? That would have been Steve Braggs. Yeah, okay. You had the first home owners grant was about 7,000 before Rudd doubled and trebled it, and that was 7,000 when average house prices were the order of about 200,000. Okay.
Right.
So he made it 21,000 for a new house. You're already talking 10% of the purchase price. In Victoria, outer metropolitan Melbourne, another 14,000. So they were giving you 35 grand to go and buy a house.
Okay.
Gee, the housing bubble started again.
Okay, all right. So, but that's what governments do.
They'll do that. They'll cut interest rates. They'll cut. They've only got 1% to go. There'll be fiscal stimulus as well.
It was, I say,
yeah.
And the bottom line is, if there's no interest rate cuts that can help, you're right, there'll be tax cuts.
Yeah.
All right, and then if there's a serious problem and the government has to eventually help prop up the banks, then maybe will be tax increases on the wealthy.
Oh no, I think that's going one step too
far.
But this is Australia, mate. We care about our, the tall poppies of blokes like me. We don't cut down the James Packers. We cut down the tall poppies like me.
Can you cope with a suit from James Packer as well?
Yes, I can.
Okay, I don't think you can. All right.
I think James has got a sense of humour. I hope he has.
Well, probably he hasn't. But the bottom line is this. What if economic growth comes along stronger than you expect to offset? Because remember,
that is a very good empirical question, and the best person...
Well, I used to be an economist, but go on.
Okay. The best person on that is actually... The name is a completely opposite of the personality.
Okay.
Richard Vague. Okay, Richard Vague is a billionaire American philanthropist who established two of the country's leading credit card companies, made his fortune that way, saw the crisis coming because he was seeing...
What year was this?
2000. Okay, saw it coming because of the data he was getting on mortgage debt as well as credit card debt, and decided that he had to get out of the market. He sold his card company to Barclays in 2005, the second one. And he then has done tremendous empirical work since then, looking at bubbles around the world over the last 1.5 centuries. There have been roughly 150, that every last one was a credit bubble, private debt getting too high, credit collapsing afterwards. And said the idea you can grow out of debt sounds convincing. He said the only instances he's found of that are where you had something like an export boom in Saudi Arabia, where the oil price quadruples and therefore you can, the GDP grows far faster than the debt. Every other case involves some form of debt write-off at some point. So it sounds nice to say you can grow out of it. Empirically, good luck, because 150 times, it's only worked twice, and that's in countries like Saudi Arabia with an oil price boom.
Can the exchange rate help in any way?
Exchange rate does help, because again, if the exchange rate goes down, that means you can buy less internationally. You will have your demand is more domestically focused.
And our debt is not as foreign oriented as it was in the 80s.
No, I mean, this is one of the things people get wrong, and it took me a while to work this out myself. They say that banks are borrowing offshore, and their borrowing costs are going to rise, and they borrow offshore to lend locally.
And that happened in the 80s.
Well, what they do, they borrow offshore in American dollars as get them long-term equity, because you know the idea when you get long-term debt's equivalent to equity in working out your capital weightings. They don't lend it, it gives them money they can leverage up. So the banks might find with the fall in the value of the dollar, their costs rise. So that's a negative for the system.
Okay. Now, Keynes made the remark, and I know you've read a little bit of Keynes in your lifetime.
A few words, yeah.
That a market can
remain irrational longer than you can remain solvent.
That's right.
Yeah, absolutely.
Yeah.
And that's to the market.
Because the longest boom I've got in recent times was a 15-year in the 50s, when debts were really low.
Yeah.
And the stock market went up over 900. US market went over 900%.
Yeah.
The current US market's up about 320%.
Yeah.
So we're past the length of average time. The actual rise in the market is not as big.
That to me, this is the Federal Reserve market. I mean, it
It could go on longer than we expect.
Oh yeah, like if the Federal Reserve is willing to back this, and this is actually one market I'm going to predict going up in Australia. Okay, so because I can't get sued by the Reserve Bank for libel.
No.
Okay, the Reserve Bank.
They're used to being criticised by people.
They're brain dead. Okay, they will do exactly what the other central banks.
You've said that before, but go on.
Okay, they will do exactly what other central banks have done, which means they'll dive into QE when the market starts to fall over. Because speaking of banks being as much of the index as they are, the market will go down when the recession hits. They'll be worried about it, and they will go what the other banks have done, which is QE. QE, quantitative easing, is buying bonds off the financial sector, which gives them cash. As financial institutions, all they can buy is financial assets. They'll buy shares and also some property. That'll drive up share prices. Because when the Federal Reserve began QE, the S&P, and I love this number, was 666. It bottomed at 666.
Very devilish.
You'd know better than me what it is now. What's it now?
What you're talking about, Dow Jones?
S&P.
S&P 500. Well, actually, in fact, I don't know. What
2,000 and a bit. Okay, so it's trebled over time.
Dow Jones is 27,000.
Okay, well, the same sort of thing is going to happen when the Reserve Bank dives in. Wait for the market to fall over. Watch when they start talking QE, then buy in and just hold on, because the shares will rise under the pressure of central bank money creation for the financial sector.
Okay. Now, this is about how you sleep at nights. Right?
Badly, but anyway.
Well, I was going to say that. Do you worry that your 2008 predictions didn't materialise, and could you be wrong, and the muddle through thesis will again make you look like you're wrong?
No, the trouble is I was wrong about the phenomenon. I was right about the cause. Okay? And the cause is, when you look at that correlation I showed for the American data between house prices, a change in household credit, which is change in new mortgages, and change in house prices, correlation coefficient is about 0.7. Okay, when you look at the Australian, it's about 0.65, but much more volatile. But the basic same story.
But people don't understand, Steve.
Okay,
because you're normal people watching this as well.
Okay. What I'm talking about.
But the bottom line is
the cause applied, but the government stimulated borrowing so much.
Well, you and I would never have expected negative interest rates in Europe. We wouldn't have expected even what we did here. So it wasn't expected.
Yeah.
And this is the problem for you, is that you are in uncharted waters when it comes to macro policy in this country, and even prediction of prices.
Globally.
Yeah, and most people were unaware of 40% house price falls and the relationship to debt. And as you say, a lot of economists ignore it.
Yeah.
So if we muddle through again,
well, I think if we muddle through, what we'll do in stagnation, not growth, because when you look what's happened in the rest of the world,
we'll become like Japan. And then
if you back in my first edition of Debunking, which I wrote back in 2000, I said I can see the world turning Japanese. You'd be old enough to remember the
Good song. Good song.
Okay, good song. That is that once you get through the crisis, you've had extremely high levels of credit, and the aggregate demand, and I've proven this mathematically, is the sum of the turnover of existing money plus credit. Okay. Now, back in Japan's case, turnover of existing money was slowing down, but credit was running about 30% of GDP. Since the crisis, it's been to be normally negative. So you have a huge fall in aggregate demand. Without the aggregate demand, you don't get the investment, you don't get the growth, and you get a stagnation period. And whenever the economy appears to recover, and central banks following conventional economics think, we've got to slow it down before inflation hits, put up interest rates, the economy tanks because people start deleveraging again, and you bounce along in stagnation.
Because the Japanese economic miracle was a period of extremely high growth, and since that time, they've had the opposite, haven't they? Individual companies have grown, but the economy hasn't.
Yeah, they've pretty much. In fact, for about 20 years, the GDP in nominal terms was constant, up and down a bit, but pretty much flat line. So you hit a period of stagnation. Now, Japan has ultimately come through that, but in the meantime, its private debt level's fallen from 225% of GDP to about 170%.
And government debt's gone through the roof.
Gone through the roof. But they've got an unlimited capacity to create government debt. And this is one thing, again, the mainstream gets wrong.
Because they're big savers.
Well, not because they're savers, because the government can create money indefinitely. Like QE, quantitative easing in America, every year until they stopped it, and they've now restarted it to some extent, every year the Federal Reserve bought $1 trillion worth of bonds off the financial sector. Does anybody in America remember paying a QE tax? No, it's just an accounting operation. Okay. So in that sense, the central bank can do that. If the central bank banks what the government is doing, then they can run at an indefinite level of debt. And of course, in Japan, they've done it, but they've got the buffer of they've still had a trade surplus all that way through. Okay. So they've no need to borrow money internationally.
Trump, is he a help or a hindrance to your Armageddon scenario?
Trump, I was actually approached by...
It's unbelievable, isn't it?
Yeah, I mean, I was approached indirectly by a colleague, by associate of him, to get involved in economic policy advice for him. I saw a couple of performances, said no, and I won't use the verb way. Oh, well, I do that because...
It's funny, I've never thought of it, but go on.
It is, yeah, well, if you think about it.
I think more an adjective, but go on. But go on. We're not good at grammar anyway. But go on.
Okay, that's, he's got serious narcissistic personality disorder. He's a snake oil merchant as well.
Okay, can you cope with being sued by Trump as well? If I can be, but go on.
But he has good gut instincts on what works with his populace. And so a major thing for him has been the deindustrialization of America that's occurred with the transfer of production from America to China in particular by American multinationals. So he's appealing to that all the time. Partly what that's doing is for corporations, they're looking at the damage he's doing and seeing their supply chains, which were difficult enough across that distance already, becoming impossible. Partly what they're saying is we've got to bring production back on shore again, which is what he's trying to achieve. Now, the production that comes back on shore won't bring back on the jobs because there's been a 30-year change in technology. There won't be anything like the employment he's promising to his voters, but it may well be that's causing domestic investment that wouldn't otherwise have taken place. But I mean, the way he's going after country trying to achieve trade balance, the last one being India. Yes, India has a trade surplus with America, but India's got a trade deficit with the rest of the world. It's quite crazy. So,
could he cause a global recession with this?
No, I don't see trade as important as most economists do. To me, what matters is investment. Trade's all about specialisation. You know, this fantasy fixation economists have on specialisation. What really gives you growth is investment. And if what he does indirectly causes investment to occur, then it actually ends up being positive, even though from a trade point of view, it's a massive negative. But I see that being disruptive because so many supply chains are being stuffed up completely.
Okay. Now, I always finish off my interview with you saying, I hope you're wrong. And you used to say, I hope so too. But given the fact that you do need to be proved right, is it becoming harder for you to say, I hope I'm wrong too?
Well, no, I've seen like the house price falls began, as you know,
yeah, but that's,
I got those
to
right.
me, that's moderate.
We're also in a per capita recession, which is the other thing. The only reason my friends of mine call this the population Ponzi. It keeps the bubble going here.
But I don't like the per capita recession because you can get rid of that by just getting rid of people. Yeah.
Exactly what we've done.
Yeah.
Okay.
Yeah. But immigration in Australia is increasing.
Yeah, and we're going to benefit from Hong Kong as well. Lots of Hong Kong Chinese are likely to come here for the obvious reason that things aren't looking too crash hot across the border. So that's going to be a stimulus to us. We're small enough to benefit from that.
I think you're better than that per capita recession. But
anyway, no, mate. Come on, no, it matters. Seriously.
We'll argue that on another occasion. We haven't time. So the bottom line is, in a sense, you do need to be proved right. Otherwise, they'll say, "Oh, that guy Keane, he was wrong for 20 years." You need to be proved right.
Well, okay, I need to include the role of the Federal Reserve and the Reserve Bank, which will do QE, which will
fight you.
That's true. They'll fight. I know. But I'm saying it's no way to run a country. This is my whole point. Hasn't been about getting a prediction right. It's saying this is bad economic theory, and this is what leads us into positions where we end up being in stagnation indefinitely as an alternative to growth. Now, I'd rather get back to the stage where you have entrepreneurs being funded, getting decent investment occurring, and running a whole country on holes at one end of the country and houses at the other. It's a non-creative way to run an economy, and that's my main point.
Steve Keane, thanks for joining us.
Cheers, mate.
Hi, I'm Peter Switzer.
And I'm Paul Rickard. And we'd like to invite you to our 2019 Switzer Listed Investment Conference.
Now, the Switzer Listed Investment Conference brings together some of Australia's best money managers. On the day, they'll tell you how they're investing both at home and abroad and give you tips on how you can maximise your investment portfolio. Tickets are only $49 and available to purchase now. Don't miss out on your opportunity to hear from Australia's best money managers by securing your spot now. For more info and to purchase tickets to the event, head to www.switzerevents.com.au. Attending will help you make well-informed financial decisions this year and maximise your portfolio. It's our weekly catch-up with Charlie Aiken from Aiken Investment Management. Today, I want to talk about the stocks in his stable that he thinks has the most potential over the next 6 months. Charlie, thanks for joining us on the program.
Afternoon, Pete.
So obviously every stock you hold in your stable of stocks, you expect them to go up, otherwise you would sell them, correct?
That's arguably right,
Oh, you're
yes.
right. So I want to sort of treat you a bit like a horse trainer, going into the spring carnival in a sense. And so
Righto.
which one of your horses or stocks do you think has the most potential over the 6 months? And even maybe if you want to put it into context, why?
Well, it's interesting because obviously in a portfolio we weight the positions as well. So they're not all equally weighted. So
Yeah.
we might have 20 horses as such, but we've obviously got some horses that are a lot bigger than others in the portfolio.
Yeah.
So right here, right now, the three biggest investments I have are Microsoft, Alibaba and Louis Vuitton. All overseas companies, all three of the biggest, best companies in the world.
Yeah.
Only, Pete, because that's where I can really see growth. It's so hard to find growth out of many of the biggest, most well-positioned companies. So Microsoft, Alibaba and Louis Vuitton are my three biggest at the moment. But outside of that, there's plenty of stocks. I still think the world's okay.
Yeah.
I still think there's time to be invested and I still think equities look better than anything.
We'll go back to other ones
Yeah.
later. Why do you like Microsoft?
We just had a tremendous result on Friday, 15% earnings growth, beat market expectations. It is in every part of the technology sector that you want to be in,
Yeah.
be it cloud
You
computing.
can't escape it,
You
can
cannot escape it, be it email, cloud computing, artificial intelligence, laptops, everything you can think of.
It's a growing moat.
Well, it's basically almost an exchange-traded fund over technology. And Microsoft, for a trillion market cap company to be growing at 15% is exceptional. Free cash flow is hugely strong, 60 billion of free cash flow. Great business. I think you could make 15% in that stock in the next year.
If you thought that in a sense, this is the end of Microsoft's run, you'd be a seller. And obviously
Yeah.
you're a holder.
Yeah, I think it is continuing to grow its business at about 15% per annum. Top line growth is strong, bottom line growth is strong, balance sheet sensational. Buying back its shares, just embedded in pretty much everyone's computer.
Yeah.
1.3 billion daily users of Microsoft Office. You can't get rid of this thing.
No, you can't.
So I think that's a great business. It's reasonably priced. It'll probably make 10-15% capital gain over the next year. You don't have to take enormous risks to find great businesses at the moment. Yes, I've just recommended buying the biggest company in the world, but that's okay.
Yeah. Because
That's okay. That's okay.
Let's go to Louis Vuitton. A lot of people would be surprised that. Well, where is Louis Vuitton listed?
In Paris, in France, has many of the
On the CAC.
about 70 of the best brands in the world. Everything from wine through to handbags, through to leather goods, through to everything you can think of, through to duty-free stores, DFS. That you go through DFS in the airport, that's Louis Vuitton as well.
Yeah.
So to me, luxury and aspirational brands are doing really, really well, driven by the Instagram generation. They all want to show off, show how aspirational they are, show how well they're doing. The funny thing is 40 to 50% of Louis Vuitton sales now are to millennials, not to wealthy eastern suburbs.
Are they
people.
European sales or are they more
Global
Asian?
sales are 40 to 50%. Chinese sales are about 30% in total of Louis Vuitton. So that's risen from 6% in over the last 10 years. But to me, that is one of the greatest businesses in the world. It's got amazing margins, hasn't had a down year in 20 years in terms of sales, owns the best brands in the world. Stock's making record highs, but it's still growing at 15%. So another really reasonably priced great company that has it covers all the themes we believe in, particularly aspirational millennials.
Okay, Alibaba. Now, if there's one thing that made your reputation a little bit tarnished was the trade war and the impact on Chinese stocks. Just you told
it
me
was a tough year last year.
You told me about Tencent and Alibaba before anyone had told me about that, and you wrote up and did really well for a while. But the trade war has made life hard for you. How is the trade war going to be important for your Alibaba play?
Well, in theory, no, because it's a domestic retailer.
Okay.
It's not selling anything to America. It's not involved in tariffs. Its business is purely domestic. It's about 70% of its domestic Chinese retail sales to Chinese consumers.
Yeah.
The others is cloud computing and payments.
Yeah.
So it's everything I believe in too: cloud computing, electronic payments, direct to retail, e-commerce. Like it's in everything you want to be in.
Yep.
I think it's a cheap stock. It's growing at 40% at the headline level, about 40 odd % at the net pat level. Buying back its own shares, about to dual list in Hong Kong as well. It's a sentiment thing, Pete, because everything Chinese is cheap at the moment because of the trade war.
Yeah.
But this is a company still growing at 40% per annum. Massive company, 400 billion market cap. I think that could double over the next 5 years. So the things we're invested in China purely sell to the Chinese consumer. Tencent only operates in China effectively. Ping An Insurance only operates in China effectively, same as Alibaba. So we have learned our lesson a little bit. Don't be involved in trade war beneficiaries or losers. That's a bit of a mugs game because that could go on for a decade, who knows? Yeah. It seems both sides of US politics are pretty firm on that.
Yeah.
But look, I think Alibaba's a great business. I think it's cheap. Results coming up in August. I think it'll again show you 40% growth. So most of the investments we have at the moment are in large global branded companies that face the consumer that are still growing.
Is there a local stock you're holding at the moment?
At the moment, I'm zero weight Australia. I think Australia's a bit expensive. Recently just took some profits in A2 Milk. That's had a huge run. And that was our final Australian holding. I think you're going to get a chance in Australia during this reporting season perhaps to buy some slight reality checks. Markets had a huge run, a lot of movement on interest rates and beneficiaries of low interest rates. I just think it could be a little bit of a sell the fact event in Australia on the reporting season. I think you get a chance to perhaps buy a little bit lower here.
Yeah, you made the point a couple of weeks ago that was what's really unusual about the big 20% rise in the stock market this year has been driven by income type stocks, which generally don't do that. If a trade war truce is struck, is that going to lead to growth stocks taking off and there'll be a rotation out of those income stocks as people try to get their money to buy the growth stocks?
Yeah, it's interesting because growth globally, which includes technology, has majorly outperformed value, right?
Yeah.
If you saw a trade war resolution, value would rally, cyclicals would rally, banks would rally globally. It's interesting. To me, there's more a rotation, Pete, than some great market movement.
Yeah.
So you would see defensive stocks sold and cyclicals bought.
Yeah.
Now, in the scheme of things, that's interesting for Australia because we're heavy in banks, we're heavy in resources, but recently things like Transurban and Goodman Group and some of these sort of REITs and property trusts and
bond proxies.
Bond proxies have done well. The biggest risk we've all got is that bond yields actually start rising a bit now. And that would take the heat out of some of these income stocks, but not necessarily be bad for overall equity markets.
No, okay. Charlie Aiken, thanks for joining us on the program.
Thanks, Pete.
And finally, if you've enjoyed the Switzer TV experience, please hit the like button and subscribe to our YouTube channel. I'm Peter Switzer. Thanks for joining us. See you next week.